Hello and welcome to this special episode of China Uncensored. I'm your host, Chris Chappell.
And I'm your producer, Matt Gnezda. Chris, have you ever wondered what the future will be like?
We live in the future, Matt.
No, I mean the future, with hoverboards.
He's on a hoverboard!
Actually, hoverboards have already been invented. This is a real video from last year of Tony Hawk riding a hoverboard made by the company Hendo. But the downside is that it only works on a special copper-plated surface.
And not, say, on water.
Not unless you got power. But if you've watched the 1989 movie Back to the Future Part 2, and surely you have, you know what the real future looks like.
We're descending toward Hill Valley, California at 4:29 p.m. on Wednesday, October 21st, 2015.
2015? You mean we're in the future?
Wow, we are living in the future.
Yep. And that's why today we're going to look at the top 10 things Back to the Future Part 2 got right.
Number 10, TV screens everywhere.
Given that this is what a brand new Magnavox TV looked like in 1985, it's amazing that Back to the Future was so spot on with this.
Channels 18, 24, 63, 100.
Giant flat panel TVs, hundreds of channels, even a widescreen aspect ratio. Wow.
Number 9, 80s nostalgia.
So Marty McFly goes into the cafe 80s. And in 2015, the 80s are back. People love the 80s.
Well, the 80s did produce some of the greatest hosts on YouTube.
Yeah, anyway, once again, we have jeans jackets, puffy vests, goofy sweaters. Thanks, Katy Perry.
Number 8, restaurants without waiters.
Did you notice that there are no waiters in the cafe 80s?
Yeah, McFly orders a Pepsi from a TV screen.
And today we actually have that in a lot of restaurants, like Chili's. They have those tabletop tablets.
It would be more fun to make President Reagan bring you a drink, though.
Yeah, but then you'd have to interact with other humans, which kind of defeats the whole purpose.
Number 7, hands-free video games.
You know that part where the kids say,
You mean you have to use your hands? That's like a baby's toy.
well, now we actually have things like the Xbox Kinect and the Wii.
Yeah, only babies use their hands for stuff.
Number 6, machines you talk to.
Hydrate level 4, please.
Hey Siri, do you like to talk with me?
I'd rather not say, Matt.
Number 5, wearable technology.
Should have been home hours ago, but I'm having a hard time keeping track
fruit.
these days.
Wow, that looks surprisingly like Oculus Rift.
But you know what makes this really accurate? People paying more attention to their technology than their loved ones around the table.
Wait, what? Did you say something?
Number 4,
Wait a minute. Cubs win World Series. Against Miami? Yeah, it's something, huh?
Amazingly, it is actually possible for the Cubs to win the World Series this year.
for the first time in a century.
But the movie got the dates wrong, so as of this recording, we still don't know whether the Cubs will win.
But you know what they did get right? There's a team from Miami.
Yeah, Florida didn't even have a baseball team until 2 years after this movie was made. And they weren't called the Miami Marlins until 2011.
Number 3, Surf Vietnam. You might have missed it the first time, but Doc and McFly are actually standing in front of an advertisement that says Surf Vietnam.
In 1989, Vietnam was not exactly a place where you'd want to go on vacation.
But now, well, Surf City.
Number 2, drone reporters. Chris, remember when you used to be a reporter?
Yes, I was replaced by a drone.
Well, in 2015, a lot of people are using flying drones like this to take pictures and footage. And even though it's technically against FAA regulations for media companies to do it, it's being done anyway.
Well, the most accurate part here is that human reporters are being replaced by machines.
And number 1.
Hey, what's that Doc Brown looking through?
Yes. Why, it sure looks like an iPhone to me.
Boom! Considering this movie was made almost 30 years ago, they actually got a lot of things right.
But you know, they didn't get everything right.
And that's why you should check out our other video, 10 Things Back to the Future Part 2 Got Wrong. Back to the Future predicted the future traveling 30 years ahead from 1985. So, your predictions for 2045?
全世界的人都会说中文。
是的。
Great Scott!
All right.
How you like this? Good.
All right. All right, if my calculations are correct, when this baby hits 88 miles an hour, we're going to see some serious fireworks.
Correct. When this baby hits 88 miles per hour, you're going to see some serious shit.
On to some serious business. Where we're going, we don't need roads. So I want to talk to you about a little bit about my perspective on the industry. I know, looking like this, it's probably hard to take me seriously, but try. I will. I'll take my glasses off. Are we up? Okay. I want to take a look at companies that see themselves as technology companies that are not necessarily obviously technology companies. How many of you are familiar with John Deere? Right? American icon. What do they do? Tractors, right? Lawn tractors, big tractors, tractors all over the world. They actually consider themselves a software company. Any of you know that? It's really, being in Iowa, right, of course. So now you do not buy a tractor. You actually license software from John Deere, and they can upgrade it continually. Look this up. If you don't believe me, check out some case law about farmers actually suing John Deere about a tractor. This is an American icon that considers itself a software company now. Very, very different from 5, 10, 50, 100 years ago. How many of you have used Airbnb? A few? Everybody heard of it? So you know that Airbnb owns no assets. They have no hotel rooms. They have no lobbies. They have no concierge. Yet they're the most valuable hotel company in the world. What do? They connect assets, rooms, homes, second homes, whatever, with people that want them through technology. And they obviously take a nice little slice of that. How many of you have used Uber? Right? I love Uber. It's the greatest thing ever. Again, a company that has no assets. Doesn't have cars. Doesn't really have any assets other than its technology. Yet it is the most valuable transportation company on the planet by far. Again, a company that leverages assets from people like us, or probably not people, nobody's probably an Uber driver in here, and connects it with people that want to take that transportation. Think about what Uber has displaced. It's really taxis at the end of the day. And taxis were in a pretty comfortable spot. What did they have? They had assets, taxis, dispatching systems, they had drivers, and they had licenses that allowed them to drive in a certain city. And those licenses were hard to get. You know, medallions in New York City are very, very valuable. So they had legislation. They had assets. They had legislative issues that made it tough to become a taxi or taxi company. Yet Uber is essentially putting taxis out of business all over the world. Again, connecting somebody's assets with consumers through technology. So hopefully you see the analogy, right? So here in the insurance industry, we have capital, a lot of capital, assets, right? And it's in our world, almost an impenetrable barrier to entry. Raising capital to start a new insurance company is almost impossible, right? It's very, very difficult to do. Getting the ability to actually write insurance in a various territory, whatever the state is also very difficult, right? So there's regulatory hurdles that we have. Yet Uber did it. Nobody thought about Uber. Nobody thought they could do it. How did they do it? It's really interesting. Two guys came out of a bar in San Francisco. It was raining. And they couldn't get a taxi. They got really upset. Guys happened to be software engineers, entrepreneurs, and they're like, there's got to be a better way. So they created Uber Taxi, right? At first, it was just meant to hail a taxi. It's obviously turned into something much, much more. Their last valuation was $60 billion, and they're 5 years old. Incredible, incredible story. So yesterday, Mike talked about Zenefits. I want to talk a little bit more. Before Mike talked about him, very few hands came up as having any knowledge about Zenefits. Is that fair? How many people knew before yesterday who Zenefits was? A few, right? A few. So as an insurance technology CEO, I'm always looking around the tech space, looking who's getting funded, just seeing what kind of new business models are out there. And Zenefits really intrigued me. Actually, Rob Cohen turned me on to Zenefits about 2 years ago. Zenefits is actually a software company that gives away software. It's all free. They give away their HR software so you can manage your payroll, you can manage basically everything about your HR systems, and they do it for free. How do they do that? Well, they monetize that data that companies are putting into that system so that they can sell insurance. It's not life insurance, it's health insurance. They use the data so they can target people a little better. They are basically a really, really interesting agency. Now, they have run into a little trouble. They got ahead of themselves and cut some corners on the legislative piece. On the regulatory piece. And that's hurt them. These guys have a $500 million war chest. They got $500 million last year from a variety of big VCs at a $5.5 billion valuation. They are 2 years old. I do not know an insurance broker agent on the planet that has grown that fast. They went from 0 to $100 million in 2 years. They're not gone. They're not dead. They are going to be a force in this industry. They're selling health insurance today. My guess is they'll be doing property and casualty soon enough. After they stop having sex in the hallways and drinking and smoking pot. Literally, there was an email sent out about stop doing those things at the office. I swear to God. So insurance technology is really hot. When I started Valen in 2004, I had to beg, borrow, and steal my way to get investors. Nobody wanted to invest in a technology startup that was going to sell to insurance companies. Insurance companies had been notoriously difficult to sell technology to. And I think mostly because insurance technology providers at the time just frankly weren't that good, right? And how many of you have been burned by an insurance technology implementation? Right? the average lifespan of a CIO in the insurance industry is 18 months. Right? So it was just not a great time to start Valen. But we started it. We convinced a few people to invest in the company. Fast forward to today. Last year, there were $2.65 billion with a B invested in insurance technology companies. These are just a few. Zenefits, obviously. Compare.com, some of you know. Some of you are actually partners with. EverQuote, Policy Genius, CoverHound, and Lemonade. How many of you, except the people that went to my dinner the other night, how many people of you have heard of Lemonade? Who knows what they do? Daniel? Peer-to-peer, right? I don't know what the hell that means, but they are peer-to-peer insurance. I've been trying to figure out for months what they're actually going to do, how it's going to work. They just announced a bunch of reinsurance contracts. I don't really understand them yet, but it's a really interesting time in insurance. A ton of money is flowing into insurance technology. It's not flowing into it in the traditional sense, like a Guidewire or a policy management system, thank you very much, or a Valen. It's flowing into companies that are really trying to disrupt things tangentially, like Uber, like Airbnb. I don't know what it's going to be. I don't know if it's any of these companies, but the reality is there's a ton of money flowing into people that are trying to disrupt our industry. It's happening. And so a lot of people say, well, this has happened before, they're going to come in, they're all going to die, and it'll be business as usual. So back in the 90s, right, in the dot-com era, insurance tech was hot too, actually. For those of you that remember, there was a few companies that were trying to do this. A company called ChannelPoint. Anybody remember them? I mean, massive blow-up. $850 million blow-up. They were trying to do what Rob Cohen was asking for. Actually based in Denver, interestingly enough. And they blew up. They couldn't deliver on their promises. Esurance got a lot of press, a lot of money, but their venture guys didn't understand capital, didn't understand really how to do insurance. And if it weren't for White Mountains coming in and being the white knight, Esurance might have died too. But White Mountains brought capital, brought expertise, and Esurance was a tremendous success story and blazed trail on the direct business, along with Allen and Progressive. And that was a huge success story because they sold it to Allstate. InsWeb, I don't even know where they are anymore. I think they might be around. But these were three companies that had about $1 billion invested. So why is it different now, right? Why are these companies going to change things? Why is Google still around? Yes, they exited Compare, but I guarantee you they are not done. I don't know what they're going to do. I don't have any inside information, but they're not done. They're going to come back in some way. It'll be different. It'll be a different, fail fast mode, but they are coming back. I should put Facebook up there. That would be hilarious, but I wasn't that smart. So why is it different? Now, this is my opinion, okay? I think that the biggest reason is that in the 90s, it was all about .com, right? Pets.com. Let's raise a bunch of money. We'll do a Super Bowl ad, and all right, we'll do an IPO and whatever. Today, it's different, right? The internet is not a thing. It is ubiquitous. It is everywhere. It's on every phone that we have. And insurance, as we talked about earlier, John Mike's conversation, insurance is not meeting customer expectations. It's just not. As much as we'd like to say it is and think it is, it's just not. When you have an average net promoter score of a 28, we're failing as an industry. Let's not say that everybody is failing. It's just, as an industry, we're not meeting up to customer expectations. It was interesting when I did research on NPS. If you don't know what NPS is, it's Net Promoter Score. It's created by Bain Consulting several years ago. And they were trying to figure out one question that would really help understand customer satisfaction, rather than 30 questions of surveys and all this stuff. It's just one question. And the question is, would you recommend X, X insurance, State Farm insurance, to a friend or colleague on a scale of 1 to 10? 8 or above, you're a promoter. 7 and below, you're a detractor, like you're a negative. And so average insurance score of 28. So besides USAA, State Farm is a 45, Travelers is a 28, Liberty is a 14. 14. And these are big, important companies and have negative net promoter scores. So what happens today when consumers are dissatisfied? It's my view that consumers always win. Always. It doesn't matter about regulatory environment, it doesn't matter about capital, they always win. Somebody will find a way to satisfy the consumer. And it's a classic example. Innovators find ways to work between the cracks, work around regulation, use technology in some way, and it is a definitive pattern, and it happens everywhere. Not just in insurance, but everywhere. The same pattern. They go after incumbent market share with some new thinking, some innovative way of doing business. And so it goes like this. First, there's a catalyst. Think about the Uber example. Right? The guys come out, it's raining, they can't hail a taxi. These guys happen to be creative and be able to start a business. Right? That was the catalyst. And then there's a new way of thinking and some type of breakthrough. The breakthrough with Uber was not Uber taxi, but ride sharing. Right? It started with black cars. Here's an asset that's not being utilized except a couple times a day going back and forth to the airport. Why not utilize those in between those trips? That's how it started, and then it moved to UberX and whatnot. So I want to talk a little bit about a couple companies that you guys know about where this happened. First one is Capital One. So Capital One, just in full disclosure, Nigel Morris is an investor in Valen. He was a founder at Capital One. Some of you that were at our first summit, Nigel spoke about this very thing. So Nigel and Rich Fairbank were running around the country trying to sell banks on credit score. This is in the late 80s, early 90s. Nobody bought. Nobody. Not a single bank would even give them a pilot. This is credit score. You think about how ubiquitous that is today in the late 80s. So they got very frustrated. They convinced a little bank in Richmond, Virginia, to give them a little bit of capital and try it out on their own. They started Capital One in that way, and their whole mantra was information-based strategy. They couldn't compete with the big banks. They couldn't compete with the big credit card companies, so they went after subprime first. But today, some of you may have Capital One credit cards. Fast forward, right, so they created a way to leverage data, complete and utter market segmentation, and then they started using it for customer analytics. You guys remember all those goofy ads they used to show in the 90s and early 2000s? Just all kinds of goofy stuff. They were just test marketing. It was a test and learn. They test marketed everything, right? The whole airline or cashback or whatever it is. And you guys probably get these things in the mail and via email. It's all test and learn to create finer and finer customer segmentation. So today, Capital One is the largest credit card issuer on the planet by far. They're the largest auto finance company on the planet by far. And now they're a top 20 bank. These guys are huge. And it all started in the late 80s because of some frustration. So I'm not going to talk in detail about Progressive because Alan did a wonderful job yesterday. But I want to say something about Progressive. I was actually having dinner with Nigel a couple months ago. And he said, when we started this journey, Progressive was the first company that came to us and wanted to really understand what we were doing. And we taught them, we told them, and they spent a lot of time interacting between the companies. And I said, what do you think of Progressive today? And he said, he was there last summer and doing the whole dog and pony with some Progressive folks. And he said, they are better than Capital One. Capital One has long been held out as the best analytics company in the world. And here's the founder of Capital One saying that Progressive is better at using data and information-based strategies than Capital One. So Alan talked about this yesterday. I think this is hilarious, and I think this is an amazing use of data, right? It is pushing adverse selection in the marketplace through ads. It was brilliant. They're so good at pricing. They believe that if you have a lower price, then have at it. We'll do adverse selection on you. It's an amazing, amazing campaign. So what's happened in that marketplace, right? We all know that there's been a lot of consolidation in the personal auto market, and it's not through acquisition. It was market share consolidation. In 1980, 50% of personal auto was the top 10. 50%. When did you start? 79? So back then, right? Fast forward to today, it's 71% and growing fast. The top 10 are gaining more and more market share every year. It's accelerating at a pretty significant rate. They have money. They have technology, right? It's a very, very difficult market to compete in. The same thing is happening in commercial lines. So this is something that Fitch and SNL put together. This is really interesting. So this is top 10 work comp carriers. If you look at this list, the companies that are growing are known for using data and analytics. They're growing fast, they're growing well, and they're incredibly profitable. It's happening, as Jeff said earlier from the Ward Group, it's happening in comp first, and we'll move to other lines of business. Berkshire Hathaway, you look at their growth, 408%. That's tremendous, and they're big, big believers in data. Rob Darby was here last year, for some of you guys remember. So I want to talk about one last thing that in this catalyst, new thinking, breakthrough environment. How many of you have heard of peer-to-peer lending? Have you ever used it? Anybody ever used it as an investor? So the way it works, for those of you that don't know, I would go on Lending Club and say that I want to invest money or I need a loan, and another person on the other side would say, yeah, I want to invest money in a loan, and we'd negotiate some type of interest rate, and there'd be some transaction made. That's how it started. And the way it started, if really interestingly enough, the founder of Lending Club sold his business, was at a vacation, and he got a bank statement from his savings account and had 1% interest. And he got a bank statement from his credit card company. He didn't have any balance, but he noticed the credit card interest rate was 18%. 1%, 18%. He's like, that is a joke. There's got to be a better way. And he started Lending Club. So what happened is that he put up a site, and his theory was we could connect people that wanted to borrow with investors, provide a better interest rate for the borrower and the lender, or the investor. The SEC came in and said, yeah, you can't really do that, right? That doesn't work. They actually shut down for 6 months. A lot of companies would have just killed them, right? They just would have died. These guys regrouped, and they started over. And basically what they did, they figured out how to securitize these loans. The reason I put this up here is because Lemonade is going to do something, and it might look like this. The way they securitize it, I would go on and say, okay, I want a loan. You guys would say, yeah, I want to invest $10,000. And they would spread that $10,000 over 10, 15, 100 loans so that the charge-off was not as hard on the investor, right, if I failed to pay the loan. That was very successful. Now, hedge funds, any kind of institutional investor are putting gobs and gobs of money into this marketplace, and they are taking a bite out of the traditional banking world. So last year, Lending Club originated $8.5 billion worth of loans. 4 years ago, they originated $200 million. I mean, tremendous growth, right? So they figured it out, and my guess is that Lemonade is going to do something similar, and there will be other fast followers. I don't know how disruptive it'll be, but it is something that we all have to watch, not just you, but us as well. So why? Why does this happen? Why does this happen to industries? Why are banks, they're not doing peer-to-peer lending. They're not. Hazard a guess why? Why didn't banks want to adopt credit score? It's not a trick question, I promise. Anybody hazard a guess? Exactly, right? It's and not just never done it that way. It's, banks consider their clients the loan holders, right? Not necessarily the depositors. Even though depositors are technically a customer. And so I thought this graphic explained it really well. You guys have probably seen this, right? I can't tell you how many times we've heard this. God, we really want to do something. I mean, we're writing 112 combined, but we got other things to do. We're too busy, right? We've got a policy admin implementation that we've been working on for 7 years. Right, we're on our third one, or whatever it is, right? I mean, it's something bad, but it's always too busy. And it's not that people don't want to innovate or want to be on the forefront. It's just there's a lot of stuff happening in our worlds that cause us to be too busy. The other thing that happens, and this is actually a good one. How many are you familiar with Innovator's Dilemma by Clayton Christensen? Right, a few, right? So the basic notion of Innovator's Dilemma is this, that companies, once they start, they get into a mature industry. Jeff talked about this a little bit. They're satisfying their clients, right? So in this room, your client most likely is the independent agent. It might be the policyholder, depending on who your company is and how you think about your customer. And you're doing everything you can to satisfy that customer. Everything, right? And mostly you're doing it right. There's a lot of great companies in this room. But what happens is that while you're satisfying that customer, somebody comes at the market from a completely different angle. And this happens over and over again, regardless of industries. Clayton Christensen talks about it in the disk drive business. He talks about it in lots of different diverse industries, where good companies are focused on the right thing in their customer. You think about this from your perspective. The customer is the agent. Yet, making this up, Lemonade says, no, the customer is the policyholder. And we have a different way to access capital, and we're going to give them an amazing customer experience. Amazing, right? Not from an agent. We're going to give them all the expertise online. What does that do to the industry? I mean, that is a complete disruptor. It just changes everything if they're successful, because they're looking at it from a different way. Their customer is a different customer, and they always start small, really, really small, under the radar, like a lending club. Same kind of thing. It's under the radar, and then all of a sudden it's $8.5 billion, and people are like, what the hell? Right? This changes everything. This is just a funny way to think about it, this cartoon. So that leads me to what Valen's about and why we call this the innovation crossroads for insurance. I really do believe 2016 is a pivotal year. I don't think things move that fast that everything's going to happen this year, certainly not in insurance. But there's a lot of external factors that are making this possible today. Right now you guys are all very acutely aware of the investment environment. It's killing us, right? Especially companies that have grown up cash flow underwriting. The investment market is really, really challenging, right? And you can chase yield, but then the regulators are all over you. I mean, it's a difficult environment. And so you have to find ways to make profitable underwriting decisions. That's a challenge for some companies. A lot of companies here are doing it well, but it is a challenge facing the industry. At the same time, as we saw with Progressive, these analytically driven insurers are taking market share, and they're taking it a lot, right? In the comp market, you saw the top 10. Certainly in the personal lines market. It's happening all over, and these confluence of things are happening now. Not in 5 years from now, but right now. And this tech investment is crazy. I mean, $2.65 billion in insurance technology. That is a tremendous amount of money coming in. So you've got the confluence of those things. And so we think 2016 really is a pivotal year. where things have to, we as an industry have to make different decisions and try and get faster. Jean-Mike said it really, really well, right? Time is our biggest enemy. So I promised to talk about how Valen, I don't want to do a sales pitch, but I want to introduce you to some things that we work on throughout the year, things that we promise to do to help. You already know a lot about what we do, and so what I'm getting ready to talk about are things that are new. Last year on this stage, I was dressed up like a genie or something. I had funny shoes, I had all kinds of stuff. And we talked about building a cabal of commercial auto carriers, a consortium, and bringing a lot of data to the commercial auto market so we could help out commercial auto carriers. And that's exactly... I'm skipping around, I'm sorry. Let me go to new offerings, and then I will come back to this. So commercial auto has been a challenging line. It's really the most challenging commercial line. In 2004, combined was 103. Last year it's 106. Predicted to go even higher. And a lot of people have had some rate gains, but those are offset in a lot of cases, and the market's not cooperating very well. And what we've seen is that commercial auto is an accommodation line, except for specialty commercial auto carriers. Right? It's part of a package, or it's part of an account strategy. And so you don't have a lot of expertise in your underwriting group on commercial auto. Right? They're spread across property and GL and work comp and whatnot, and they're not necessarily focused on commercial auto. And frankly, the biggest thing we've seen is that the ISO rates are absolutely inadequate. ISO has the lion's share of the rates. We have not seen anybody that doesn't use ISO rates, and they're woefully inadequate. And it creates a real problem. You've got inadequate rates, inexperienced underwriters, and it's a challenging market as a result. And so we pulled together a number of carriers, some of them are here today, and we created a commercial auto database that has 370,000 policy terms. That's over a 5-year period. It's a lot of data, $2.5 billion in premium, and the key part is the claims, 230,000 commercial auto claims. That's a tremendous number of claims. You can't build an effective predictive model to predict loss ratio without the claims piece. As much data is out there about companies, the claims piece is the key. You cannot get all the data you want from D&B, but if you can't marry it up with claims, you can't build anything. The claims piece is incredibly key. Covers about 2.5 million vehicles. About half of those are power units. And it's 47 states wide. So I don't know what the 3 states we don't cover are, but hopefully they're not important. We do cover the big ones. California, New York, Florida, Texas. It's probably like my home state of Oklahoma. This is probably the best model we've ever built. Kirsten is giving me the time. So when we build models, we pull this data together. We did the same thing in comp. We pull this data together, and then we build a model across the entire market. And that's our baseline. And it tells us, A, we can do it. B, that it's going to be valuable to people. And then we use it as a baseline for all future models that you get. All the models are custom from there, but this gives us the baseline. So just very quickly, this is a model that has over 150% lift. That is an incredible model across this big of a database. So we're very pleased with how this is, how this has come out, and we just announced it yesterday. We also, this year, have entered the personal auto market. Historically, we have not been in personal auto, frankly, for the reasons that we talked about, the consolidation. I thought that it would be a very difficult market for us to get into because it's dominated by very large carriers, and very large carriers have their own data, have their own analysts, et cetera, and wouldn't be great for Valen. but we've had customers come to us for a variety of reasons. They're smaller carriers, don't have the expertise necessarily, or want help in some way. And so we've entered this market in 2016. The biggest thing that we're doing in personal auto is risk selection. The rates are set, right? You can't really deviate from the rates. It's risk selection, right? So it's a red, yellow, green kind of environment. And it's very helpful, right? You've got a rate of $1,000, but do you even want it? Maybe, maybe not. But using predictive analytics to determine that. And then the second piece is as a modifier in your rate plan, a non-credit-based modifier. Two very cool things, and it really for smaller carriers. I doubt we'll see this being used by Progressive. The thing that we learned about, it was key, many of you know that we have this platform. A couple of people have talked about how fast we get up and running. Normally when you build a predictive model, whether it's from us or a consulting firm, building the model is relatively straightforward today. Getting it implemented is not. Getting it implemented is actually very, very difficult, depending on your IT sophistication. And it can take 12 to 18 months. Well, we experienced that with Mr. Parks, somewhere, I don't know if he's here, originally, and we said, we can't do this. We have to build out this capability. So we built out our InsureRight platform so that all of the logic, all the hard work was already on our side, and all you had to do was connect to it. And in the personal auto market, that's proven to be a huge benefit. Again, time, right? We're getting people in the market very, very quickly. Any questions about those two things? Yes, Matt.
Commercial auto model help work comp carrier underwrite a fleet risk or a fleet-based exposure?
I have no idea. Matt or Brett?
We don't know yet, but that's not a hard thing to find out. And if it is an important question that any of you have in the room, then I think it's probably a pretty good question to see if we can go and answer.
I got the same question on GL. Example, is there anywhere in your databases where there is a correlation between workers' comp, if you're writing, and if you start offering out of those segments, what segments do you think that you can offer GL along with workers' comp? Or have you done those studies or no?
Great question. That's a great segue. I'll give you $5 later. So what's next? So for us, it took us 4 years to build the work comp database. It was very difficult, very hard. We didn't really understand what we were doing. We built it, and it's been very successful. It took us 10 months to build the commercial auto database. Our next project is BOP. So we're going to start that this summer, building out our BOP database, and that'll be GL and property mainly, because everybody's BOP's a little different. So we'll be able to answer that question. We're testing out, will comp models work on GL? We don't know, but we're going to be testing that out because there's just such a dearth of BOP data out there. I mean, it's just not, it doesn't exist. And so we think there's a real opportunity there, but we don't know yet. So I skipped over some stuff. I got way too excited about commercial auto. My apologies. So I'm going to finish with something I know is interesting, at least very interesting to us and hopefully interesting to you. A lot of people wonder, hey, my underwriters are doing a pretty good job. We feel pretty good, right? We're in the Goldilocks zone. Why do I need models, right? I don't want to upset my agents. I don't want to upset anything we're doing in the company. And the reality is underwriters are good, right? They've been doing a good job for a long, long time. And so we went into our data and we tested this concept. How good are underwriters? How good is a model? How good are underwriters and models together? And because we have so much data, we can actually see the result. Underwriters do a pretty good job, right? When you have the one, down here on the low side, that's good, right? You want to see this curve sloping up and to the right. That's a good thing. Right here, the underwriters do a pretty good job of segmenting risk from good to bad. Pretty good job. So then we looked at, this is across a big database. We looked at, okay, what about the model only? And we saw this yesterday, right? So the very beginning of the morning, we were talking about just underwriting only, and then we said, okay, what happens when the model is introduced? And the model is better. It just is. Tremendously more lift, 125% lift. But we have a lot of companies that say, well, I don't want to be just model-driven, right? The underwriter has a tremendous role in this process. The underwriter knows the market. The underwriter knows things that the model will never know. And so when you combine the two, what actually happens? And we can see this now in data. And so when you put the two together, the lift is staggering. It's 185%, and this is incredible, right? So you're taking the expertise out of the underwriters' heads, marrying it with the analytics capabilities of a model, and getting it's huge lift. And so, Matt talked about being in a company that was only model-driven. They missed this whole side of the lift. I mean, and so those companies that are marrying the two together really are winning in the marketplace. That is what I'm going to leave you with. This is something we do every year now. We track all of our customers through SNL. We're trying to make sure we're actually doing what we say we're gonna do, and that is perform. Right? At the end of the day, what you want out of us is better risk pricing, and if we're doing our jobs, you're killing it. So this is the class of 2012. Companies that started with us in 2012. This is an average number, and it's an accident year loss ratio. So the market improved. This is work comp. Is it work comp only, Brett? Yeah, work comp. The market improved 10 points, but Valen clients improved 20. Pretty incredible, right? And the difference is the model. Now, they were a little worse than the market, but not all of them were. This is over a pretty big cross-section of companies. With that, I will. Do I have time for any questions? Probably not. If you want to ask me questions, I will answer them. And I know it's hard looking at me in this ridiculous costume. Thank you very much. This really closes up the content portion of the summit. I'm still just absolutely stunned that all of you are here, and I thank you for your attendance. Thank you. Enjoy the tequila.